Financial independence is all about some number on your account statement. Or even worse, that you don't qualify because of where you started out. That's just not true. It's not about some well-kept secret of the wealthy. It's about finding the right information and knowing how to apply it. On the Get Ready for the Future show, we're answering your questions so you can start making real financial change today. The journey to true financial independence begins right here, and it starts with you.
We're continuing our mission to help people discover, protect, and share true financial independence with another episode of the Get Ready for the Future show from the 6th floor of 3 Financial Center in West Little Rock, Arkansas. Welcome aboard. Whether you're listening to us on radio, on podcast, online, wherever you get the show, we are glad to have you with us. We've got questions we're going to tackle again today in the realm of finance, retirement, investing. Social Security's on the board today, as well as I welcome in Janet Walker, a co-founder of GenWealth Financial Advisors. We are just commenting to ourselves as we get ready to go on the show today that it is the final episode in May. Just came out of Memorial Day weekend as we sit here and record today. The unofficial kickoff of summer didn't really feel like it in Arkansas this weekend. It was raining and cool. But as you get into that summer mindset, it is always a good opportunity for us to plant that seed again as you think about your summer vacation. And think about how much time you spend. If you're taking one this year, how much time did you spend planning your summer vacation? And you think about it, have you spent that much time planning your possibly 20 or 25 or even 30-year vacation from work, your retirement? How much time have you spent planning that? You know, we talk about that often about, I'm a pretty detailed planner when it comes to vacation because you have a pretty good vision of what you want to do.
Right. I think the vision part of it is key. You know, a few years ago, it was pretty popular that there was an app that would like age a picture of yourself, and show you what you would look at and what you would look like 20, 30, 40 years older. And it was hilarious to look at. And mine is probably pretty accurate because it looked like my mother and my grandmother. And so it's probably pretty on point. But the reality is we are psychologically wired in such a way that we really have a problem seeing ourselves at a point in the future. Mm-hmm. And that goes to, that's why people maybe don't take care of their teeth. They're not thinking, hey, I'm going to need these things in 40 years. Right. There is a lot of things like that, and their finances are part of it, that they, even though they talk about retirement, to envision themselves in retirement is a skill set that frankly most people have not developed. And so I think it's very important to spend more time thinking about your retirement than we do our annual vacations. Yeah,
there's a lot of it that is behavioral, and it gets into the psychology of spending. If you've never heard that term, I want to encourage you to get a little bit more information on that by subscribing to our fastest 4 minutes in finance. If you haven't done this, all you have to do is text the word FAST to 501-381-5228. If you're watching online, you see that number on your screen, 501-381-5228, or just go to fastest4.com to sign up. Now, here's what to expect. Every Friday, you're going to give us your email address, and every Friday, we're going to deliver a video to your inbox that is 4 minutes or less. That's the name, and that's the promise. Fastest 4 minutes in finance. So it's 4 minutes or less, and it's topical. A lot of current events driven. We'll talk about tariffs. We'll talk about inflation. We'll talk about the market and the economy. But we're also going to talk about things like this week, behavioral psychology when it comes to spending. How can you better visualize retirement and then work with a financial advisor to put numbers behind the vision? It's worth checking out. Fastest4.com, or you can text the word FAST to 501-381-5228. And if you're worried about giving us your email address, we're not going to blow you up with a lot of extra emails. It's just to subscribe to that Friday morning video that we release and get some information in your email inbox. You can watch it some weeks and not watch it others if you don't. But I want to encourage you to do that if you're not already a subscriber. All right. The pitch is over. Now let's get into the questions. First up today, it's Tony from Hot Springs. We're both self-employed and in our late 40s. We've got about $100,000 in a SEP IRA and are saving around $2,000 per month. Should we consider setting up a solo 401k to save more or focus on building our non-retirement accounts? So we got two business owners, one goal. Save more for retirement. Is it the SEP or is it the solo 401k? We're going to compare these tools that really every entrepreneur, Janet, should know about.
Yeah. So let's talk a little bit about how each one of them work. With the solo 401k, $23,500 is the contribution limit for those who are in their 40s, which is the age group that Tony said he and his wife are in. There's a catch-up contribution for our listeners who may be over age 50. You can add an additional $7,500 to that amount, so that would bump you up over the $30,000 amount that could be contributed. And then the employer contribution can be up to 25% of compensation. Now, Scott, I'll pause here just a moment to talk about how business owners, especially small business owners, sometimes compensate themselves. They don't necessarily do it as W-2 income, as a salaried employee. So be sure that you're paying attention to how you pay yourself and therefore how you would calculate this. So that total is capped at $70,000. And that is, as a 401k, even though it's a solo 401k, it is going to have administrative fees, third-party reporting, so there is some expense to this and that not all of your other choices are going to have. And before we go on to the SEP, I want to hang out just a minute on how you might be paying yourself. This is a little bit of a sideline, but realize as a business owner that, yes, you may be avoiding some taxes on how you're paying yourself. You may see that as a benefit right now because you're not having to pay in as much into things like Social Security and Medicare, et cetera. But the negative is in retirement, you will not have paid into Social Security, Medicare, et cetera. So be sure that you're not robbing your future self by just paying yourself on distributions rather than salaried income.
Yeah, this goes back to what we were talking about at the top of the show. You're worried about current tax years and not worrying about your retirement. My dad actually fell into this trap as well. For years, he was self-employed, entrepreneur. He was worried about paying the smallest amount he could in taxes year to year. He is now in retirement and 81 years old. His Social Security check is not nearly what it could have been or maybe even should have been because he didn't pay those Social Security taxes over time. So a big point there for sure. And then as we move into the SEP IRA, which Tony is already doing, he says, with he and his wife, but for everybody else, just to kind of put some nuts and bolts around that, it is calculated much differently in terms of how much you can put in it. Now, the total is about the same. Well, it is exactly the same. You can actually max out at $70,000 just like you can in the solo 401k. But I'm betting that the reason Tony is considering the solo 401k as an opportunity to put more money in is because the SEP is calculated as a percentage of the employee side compensation. Now, the contribution is exclusively made on the employer side, and it is up to 25% of the employee contribution. So there is a great opportunity to get $70,000 in there in a year, but you have to pay yourself a significant amount of money to do it.
Just to be clear, just so our listeners aren't misinterpreting, I think you said employee contribution, and it's 25% of the employee compensation. Yes. Right. So just be sure that you're paying attention to that. One of the things that we want people to be intentional about thinking ahead on with the SEP is that if there are other team members, and Tony, you didn't mention that in your question, but if there are other employees, then since you've already got a SEP, you're aware of this, but as you potentially add other people in the future, that might be something that you don't want to do in the future because you have to do the same percentage of everybody's income, and some people don't want to do that for everybody across the board. They would rather the employee contribute and then the business match rather than the business doing the full compensation amount. Yeah,
so the other piece here, he asks, should he focus on setting up a solo 401k to save more or focus on building our non-retirement accounts? I think a piece to this that we would need to know the answer to, Tony, is what's the purpose of deciding on the non-retirement accounts? Is this still intended for retirement? Because non-retirement accounts can be great for retirement. Taxable accounts can be used to offset the ordinary income tax that you're going to owe in retirement and can really help from a taxation standpoint there. But if there are intermediate goals to consider here, intermediate financial goals that you might need to access some of your funds, some of your savings prior to age 59 and a half, then obviously the tilt's going to go towards non-retirement or taxable accounts. So how do we determine all of this? Well, you think about making a plan first for every dollar based on your goals. That's the next step. We need to determine, Tony, if you and your wife are on track for true financial independence. And you get to tell us, the input on that is what date in the future do you want that to be? What is your realistic goal for being financially independent? And does that actually mean you're going to retire? Is it going to be a full stop, or are you going to still work part-time and include some part-time income there from your business? That certainly might be an opportunity as a business owner. But once we've determined, are your retirement contributions enough to get your asset level to the place it needs to be able to provide you income if you need it at a certain date in the future, then we can begin to look at other places to put the contributions.
You know, one of the other things, just to briefly mention this, and we don't know that it would be a fit for Tony, but I think it's worthy of consideration to look at also a defined benefit plan as a possibility. That's not a retirement plan that a lot of people think about for a small business, but we have a significant number of clients who utilize that. It gives them tremendous tax benefits on the front end of things. So just another thing to consider, and sit down with an advisor and walk through, Scott, as you were saying, based on your situation, what's going to be the best approach for you.
Yeah, and I want to take a minute to address other business owners who might be listening or watching on the Get Ready for the Future show. If you're a business owner like Tony, we want to encourage you to be on the lookout for a special announcement from the GenWealth team in the coming weeks. You'll want to save the date for our upcoming Business Owner Summit. So stay tuned for details. Still working all of that out, but there's going to be a great opportunity for business owners to get some insight on investing and planning for their own retirement. There are unique vehicles, types of accounts that we've already addressed on this question that are available to business owners, but so many are not taking advantage of it because, again, the mindset is current, obviously turning the profit, getting income now, avoiding taxes now or minimizing taxes now, but planning for the future is often something that's overlooked as a business owner.
You're absolutely right. And John and I, as owners of GenWealth, there was a stage when, even though this is what we do, you know, there's a stage early in any business where it's just, man, we're just focused on trying to make it, you know, and getting the company established. And it's really easy to go from that to we're crazy busy and don't have time to deal with that. But you just have to take the time to make it a priority.
So that's coming up. Listen for future information about that. You can always check out our website too, getreadyforthefuture.com, to find anything about our upcoming events. Next up, it's George via email. I've got $700,000 in retirement accounts and a $2 million term life insurance policy that expires at 70. I'm 63 now. Should I look at converting that to permanent coverage or just let it go? So you got a big life insurance policy expiring at 70. Should you convert it, cancel it, replace it? Let's walk through the options before that clock runs out in the next 7 years. So the number one question here is, are you self-insured? We generally look at life insurance as a bridge from the time where you're not self-insured until the time that you are. There's obviously times early in life where you have kids, where you have a mortgage, where you have education needs, where you have future income needs that need to be met if you don't come home from work one day. Your income stops because one spouse passes away. But now that you're 63, George, do you have a plan to know if you're truly financially independent? Because if you are, I think that's the first box to check. If we know how much he has in his retirement accounts, which he hasn't told us, we don't know what your income needs are or other sources of income like Social Security and pension, but building that retirement income plan will let us know, are you self-insured? And at that point, we know that his after-death needs that would have to be attended to by his family would be met by his assets.
Another possibility that might be in place for George that we haven't mentioned yet is liabilities. Like, will you be able to walk into retirement with your house paid off or not? And that might play a factor in how you come to this decision. But when we talk about being self-insured, I want to develop that a little bit, because at GenWealth, we don't believe in most circumstances. We don't believe that most people need to carry life insurance into and through retirement. There are some situations where it is absolutely the wisest thing to do. But in most cases, we don't believe that's necessary. And it goes back to what Scott was talking about being self-insured. If you think about it, if you're 35 years old and you're married with kids and you don't come home one day, then your family, in order to maintain their current standard of living, needs a big life insurance policy. But by the time you get to age 70, you were already planning to not work. At some point, whatever your timeline is for retirement, you were already planning to not work. So can your paycheck, if you will, be replaced by your investments and Social Security to supplement that, potentially a pension? Can all of those sources of income come together to maintain your current standard of living for you and anybody who is now dependent upon you? So I'm sure that at this point it does not include children, but it would potentially include a spouse as well at this point. So would that income that you could take from those resources be enough for you to be able to maintain your standard of living? And if it is, then you are self-insured and you don't need to have this. And then we look at, okay, if the need is not really to replace the income anymore, is there an insurance need that you have? And if so, many times we would look at long-term care. And I would say on that, George, the sooner the better to make a decision in that direction, because the older you get, the more expensive that coverage is going to be.
Yeah, that is an opportunity for people who oftentimes have cash value or whole life policies to be able to convert that cash value from a life insurance policy and make it a down payment, or maybe even fully cover a long-term care policy there, because the need has clearly shifted. And that is the one thing that is very hard to determine if you are self-insured on. Do you have enough assets? And it's $700,000 for two people if he has a spouse, which I think he said he did. I don't even remember now. Did he say he had it? No, he didn't say. If he is married, especially, but even if he's single here, the long-term care need could be so great at some point in the future that it could deplete your assets in that way. So if you have a legacy desire, or if you just want to be able to maintain your standard of living, or one of the things I've become very fond of saying, Janet, is the long-term care insurance isn't so much to protect the one that goes into the facility. It's it's to protect the one who stays behind.
You're absolutely right, Scott. I think it's really important as a society that we begin to shift our mindset on long-term care insurance. People think of it as, well, that's for a nursing home. And again, because they can't envision their future selves, then they don't ever envision themselves in that situation. They feel sorry for people who are, but Lord knows it'll never be me. Well, those people thought it would never be them either, and it is. So in thinking about long-term care, the shift in the mindset needs to go to, this is an opportunity for me to ensure my dignity and independence throughout retirement, because that's what people lose when they're in a situation where they need care and can't afford to pay for it. They're losing their dignity and their independence. Many of these policies are actually built not for you to go into a nursing home, although they will cover that if that's necessary. They're built for you to be able to stay at home as long as possible. And that's something that we would all like to be able to do. So to be able to just consider, George, whether or not that is the next logical step in terms of your insurance needs, what I would say about it is to make an intentional decision. Not everybody needs to have long-term care insurance. Not everybody can afford to go that route. But I do think it's important for everybody to look at the facts for your individual situation and make a well-informed decision. And after you've made that decision, move on. But the reason I think it's so important to commit to making a decision is if you don't do it now and you just put off the decision, then 2 or 3 years later you decide you want to do it. Either it's too expensive or you've developed some health issue in that period of time that has now made you uninsurable. There's all kinds of scenarios we could play out that, Scott, you and I have seen in person. So just be intentional to make the decision.
Great question, George. Thanks for sending it in. And we're going to name your question the question of the week. We will send you a Get Ready for the Future Show tumbler, but we just need to know where to send it. If you want to claim it by sending an email to us, show@getreadyforthefuture.com. And if you would like to be the question of the week, you have to send a question. That's the way it works. And you can send it by text or leave us a voicemail. You can send it to 501-381-5228. We want to hear from you. Any question about your finances, retirement, investing, the economy, the market, nothing's off base there. 501-381-5228. A text will do. A voicemail will do. You can also send it via email to that same email address I just gave out, show@getreadyforthefuture.com.
Scott, you actually have one of the tumblers if you want to show everybody
spin it
who's
around there
watching
for
us. Yeah.
Those of you watching online, that's what it looks like. It's got the nice grooves down at the bottom. It's a great mug that I try to always have with me, but if I leave it on my desk, it disappears. That's how popular it is. So I don't always have it on the desk, but today I do. So if you'd like to win one of those for being the question of the week, get that question into us. Maybe we'll name you the question of the week next week. Our next question this week is from Peter in Mayflower. I'm 52, divorced, and likely won't remarry. I've got $300,000 saved and no pension. Should I be planning any differently than a couple would? I feel like I'm flying solo without a roadmap. Peter, thanks for the question. And definitely, if you're divorced, you're 52, the traditional retirement playbook is probably not still relevant as it would have been in comparison to when you were married. Singles need a totally different strategy. And the first thing we want to take on here is Social Security, because there are some things you need to know about, first of all, that if you don't know about, just to be aware of. So from an education standpoint, if the marriage lasted at least 10 years or longer, you could be eligible for a divorced spouse benefit. So when you think about that, Janet, people don't realize that if he hasn't remarried, and if he really won't remarry, because that is a qualification too, you can't get remarried. But if the marriage lasts at least 10 years, there is an opportunity to draw off of the divorced spouse benefit if it's larger.
Now, Scott, when we talk about this at live events, inevitably there is a hand that goes up and somebody will say, does the ex-spouse have to know? You know, like, and no, they don't. They don't have to know. And then somebody will ask, and it happens almost every time, seriously, somebody will ask, well, can we tell them if we want to? They get a little bit snarky about it. But you can inform them if you want to, but all you have to do is go to the Social Security Administration and take the ex-spouse's Social Security number and date of birth, as well as your marriage certificate and divorce decree. Those two documents are going to prove that it's been a 10-year time period or longer that you were married. And then with that, they will be able to give you at various ages when you could claim a divorced spouse benefit and what the dollar amount would be. Those amounts actually change every single month, so it's a really long printout. But if you think about when are you going to retire, what are the benefits that you already have in place, and Peter, we don't know that the divorced spouse benefit would be the better route for you. It may be absolutely in your best interest to claim in your own name based on your own earnings. The divorced spouse benefit has no impact on the benefit that the divorcee is going to receive, so there's zero impact on their benefit, but it does give you an opportunity for some additional choices to analyze as you go through and get ready for retirement. So even though it's a while before your Social Security claiming age, I would go ahead and get that information now, and then in the future you can go in and get an update on that, because it will change with their continued earnings in the future as well.
And I think the other couple of things we want to bring out that are really more of a retractor on being single in retirement is if we could just half the income, everything would be great. And certainly you won't need as much income as you would probably as being a married couple, but we don't half it, right? I mean, there are certain things about living expenses that are going to be more than half still. I mean, you're still going to have to pay potentially a mortgage. And if the divorce is recent, that's a big decision right there, a housing decision. Who stays in the house, or do both people leave the house, and where do you live, and how does all of that work? And the career moving forward for income prior to retirement, a huge consideration there too. But once you are into that, you'll realize obviously that utility costs are not really cut in half just because one person is living there. Food costs might be, and other costs, clothing costs might be. It might even be more than cut in half, depending on who liked to buy the most clothes. But your income is still going to need to be more than half of what it was. So if you're halving assets upon the divorce, that can be difficult to overcome. And then the other piece of that is the taxation is not going to be favorable for a single filer. We know our tax brackets at the federal level are not as favorable to single filers as they are to married filers. So building an income plan that identifies your needs, your basic lifestyle needs, and your desired income, and estimates the appropriate taxes, knows what your gross monthly income need is vitally important for a single person.
Peter, one of the other things that you didn't really ask about, but I would absolutely encourage you to consider, is to do a very thorough beneficiary review. I can't tell you how many times in GenWealth history we have seen the name of an ex-spouse on a document as the beneficiary, and it was definitely not done intentionally. Nobody in the room wanted that to happen, but it happens. So be sure that you check your retirement plan at work. Be sure that you update the beneficiary on that, as well as any life insurance policies. And then another thing that people don't think to do, and you probably don't have anything set up on this already, is your bank accounts, checking or savings account, CDs, etc., to make those payable on death. And Scott, this is the craziest thing to me still. Banks do not automatically ask you, do you want to make this payable on death? I think that they should, because to me it's just like a beneficiary question on a life insurance policy. You would never get a life insurance policy and not fill in beneficiary information. You should not have a bank account and not fill in beneficiary information. But the same is true of non-qualified investment accounts. And a lot of people aren't familiar with that terminology. All it means is the IRS doesn't look at it as retirement money. So it's not an IRA or a 401k, those types of things. Those are technically not beneficiarizable assets. They're not beneficiarizable accounts. And so there's not a beneficiary line when you set up those accounts. You can do on those a transfer on death. It does the same thing as payable on death at the bank, transfer on death for non-qualified investments, and then beneficiaries on everything else. So be sure that you review, I'm going to loosely use the word beneficiary, whether it's POD or TOD. Be sure that you review beneficiaries on everything, and if you don't have somebody on there, be sure that you list that. And I would also say, kind of to go along with that, Scott, is estate planning, just to take care of something like the house, as an example. Absolutely.
A lot needs to be redone, or at least re-looked at for sure, in the instance of a divorce. Great questions. I want to remind you to subscribe to our YouTube channel for exclusive content you can't find anywhere else, to help you discover, protect, and share true financial independence. Just search for GenWealth Financial Advisors. On to our final question today on the show. It's from Harriet from Little Rock. We're 57 and just became empty nesters. Should we take the extra cash flow and max out retirement, or put it toward paying off our $40,000 HELOC? Great pivot point for you, Harriet. The kids are out. Cash is freed up. Now what? Pay down debt or max out savings. So let's talk about the opportunity here, and this is really how you should look at it. It's an opportunity. It's been our experience based on working with clients that this is the moment in time where you can really make some impactful financial decisions and do some catching up if needed. So your mindset is in the right spot. I think these are probably the two right priorities to have. Pay down or reduce debt, and make sure that your retirement is in place. So here's how we would go about taking a look at this. First, I think, Janet, there needs to be a current assessment of Harriet and her husband's retirement savings and her current contributions.
So, Harriet, depending on what your timeline is to retirement and these other factors that Scott mentioned, we can then look at that and determine if you're on track for retirement or not. And if you are on track, then we want to press pause on adding anything extra there, and we would focus on paying down the debt first. But we might still balance that out, because we could accelerate your being on track for retirement, meaning, a lot of times people don't really get to pick their timeline. They think that they're going to pick when they retire, but maybe their health or their company pick when they retire instead. So it wouldn't hurt to be a little bit ahead of the curve on that. But we definitely want to make sure that you're on track on your own timeline. If you're not on track for your timeline for retirement, then we absolutely need to accelerate that. And then the same concept on the debt is I would run, and this is something that an advisor can certainly do for you, I would run an amortization schedule on your current mortgage payoff and see where you're going to be. What age do you want to retire? How much would you need to add to that monthly payment in order to be done by your projected retirement date? It may not be a whole lot if you add that every month, but if we have to prioritize, Scott, rolling into retirement with a mortgage or without versus rolling into retirement with it fully funded, obviously we're going to say fully fund your retirement. I'd rather you have a mortgage for a short period of time and be ready for retirement than the other way around.
Yeah, and we're talking about the contribution amounts here, the dollars, whether to allocate to retirement savings or to paying off the debt. But the other piece of this is the growth, the future growth. So if you can, I think that's a great path to be able to set a destination in the future, which may be your retirement date, and know that you can do both, basically. You can increase your retirement savings and accelerate the payoff of that HELOC. Now, we also don't want to assume that the HELOC is the only debt you have. It certainly sounds like it might be in with your question, but you need to consolidate all of that debt into one payoff plan. So if you do have some high interest credit card debt, we want to attack that. We need to look at auto loans, and this is a HELOC. Is there a primary mortgage? We can incorporate an overall plan to get debt-free by your retirement as well, and still potentially increase your retirement savings as well. Now, before we leave this question and leave the show, another couple of considerations for extra cash flow. So for other people listening out there and go, hey, well, I don't have a HELOC. I don't have any debt. I'm already maxing out my retirement. Looks like I'm good. What else is there to do? Well, there are some other things, too. I would ask, do you have access to an HSA, a health savings account? Because the other big piece to this is the healthcare puzzle. And we know there's going to be thousands, tens of thousands, maybe even hundreds of thousands of dollars that you're going to have and pay out-of-pocket healthcare expenses in retirement. So the more you can load up on the HSA in your pre-retirement years, certainly the better, because as you may know, that is a huge tax savings to you. You actually get a tax benefit for the contribution. You get tax deferred and tax-free growth, and then the withdrawal is tax-free if it is taken out for qualified medical expenses. So certainly building up a huge nest egg there in the HSA. And then the other piece that we've already kind of alluded to today is the long-term care piece.
And I think Harriet's at a great age to address long-term care. A lot of people will say don't do it until age 60. I have personal experience where I met with a client who I just felt like I needed to talk with them about long-term care, and they kept telling me no. And I'm usually not that person who will bring something up repeatedly. If somebody doesn't want to talk about it, we just move on. But I really just internally felt we need to talk about this. And then a couple of years later, he came in for just a review of everything that he had, and I noticed he was talking kind of funny, and I thought at first he had had a stroke. He was 57 years old and had been diagnosed with Lou Gehrig's disease. And so, I had the peace of mind to know that I had at least broached the conversation, but not the peace of mind to know that, and we got to a point where, they committed to do this, that type of thing. So it's not too young. I'll say that. It is absolutely not too young to look at long-term care coverage as a consideration. Yeah, some great things and a great opportunity as the kids are out of the house and you become empty nesters to hopefully free up cash flow, and hopefully those kids are getting up on their feet as well. That it's not always a full stop there, as we know. Right. Just because the kids are out of the house doesn't mean the support is completely lifted. I'm certainly living proof of that. I know you are too as well. Absolutely.
But they're getting there, right?
Yeah, it might be a yield sign instead of a stop sign on the support. But, I think for our final thoughts today, I would encourage Harriet, especially in this transition and becoming empty nesters, so you've got money freed up, but really anybody out there who's in any transition, if you've changed jobs, if for whatever point for whatever reason you have a pivot point in your life, I would really encourage encourage you to look into, again, what your employer offers, whether it is a corporate retirement plan of some type. Maybe you weren't participating in it before, but now something has changed and you would be able to do that, even a small amount to just get started. But also things like we mentioned the HSA for Harriet. We added an HSA for our team here at GenWealth just in the last year, and that's something that was not available in the past. And so even long-term people who have been here for decades are like, oh, now there's something new that I can do. So there are a lot of opportunities out there. Just be sure that you continue to make yourself aware of what they are.
I would say for my final thought in closing is, once again, we started the conversation today talking about trying to create a vision. Visualize what your retirement is going to be. Obviously, it is complex, whether it's divorce, whether you're self-employed, whether the kids are just now out of the house and you have an opportunity to save more. There are some decisions that need to be made, and it starts with the visualization of what does retirement look like for you. An advisor here at GenWealth can help you create that vision and a concrete plan to achieve it. So we hope that you'll take an opportunity to do that as you get closer to retirement. And that is all the time we have for this week's show. I hope you'll join us again next time, and we hope you'll take the opportunity to ask us a question. What's on your mind? Send it in via text message or voicemail to 501-381-5228, and we will see you again next week.
The GenWealth financial team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial. Member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.